Bitcoin is a commodity that is scarce, where the primary use case is money, or that is a long-term store of value. So the reason you want to hold Bitcoin is you want to own a product on an open network for a long period of time, and its use case is to be money. When you're holding a stock, you're holding a share of equity in a company. In essence, you're owning a corporation. The first risk of any investor in an equity is governance risk. You're risking your money based upon proper corporate governance exercised by the board of directors and by the management.
Welcome back at Market Empire, your partner giving you your daily dose about the latest crypto news and thoughts of different analysts and investors. Watch it till the end of the video. In a recent interview with the Bitcoin layer, Michael Saylor, an American entrepreneur and corporate executive with decades of expertise managing a publicly traded corporation, described himself as follows: when investing in shares, every investor should study Saylor's key trade secrets. Saylor, whose software business boasts the highest Bitcoin stake of any publicly traded company, explains why the main crypto asset is better to stocks and stock indices as a long-term store of value. The cryptocurrency sector was developed to insulate astute investors from the flawed and poorly supported world of traditional finance, despite the fact that global stocks surpass the cryptocurrency market and market capitalization by a significant margin. It is not difficult to recognize that the far younger sector is a vast improvement over the century-old stock market. Critics of cryptocurrencies and other digital assets cite the industry's high volatility, regulatory risks, and the fact that digital assets have no intrinsic value as significant deterrents to investing in crypto. In the same vein, they argue that investing in stocks is supported by its long history of solid returns, stronger regulation, and most importantly, the fact that the success of the underlying company is contingent on the investment. Critics of cryptocurrencies assert that stocks have an intrinsic worth, but cryptocurrencies such as Bitcoin and Ether do not. Saylor shows in his interviews why these factors have always been regarded as benefits for stocks. If you were still uncertain about whether to invest in stocks or Bitcoin, you must watch this entire video.
I think there's two questions there, like how does Bitcoin compare to stocks, and then why do people own equity? Why don't I start with the first question? What's the difference between Bitcoin and owning a stock? I think that, first of all, Bitcoin is a commodity that is scarce, where the primary use case is money, or that is a long-term store of value. And its use case is to be money. And so the value and use is store of value. But I think it's instructive for an investor that's thinking about whether they want to allocate to Bitcoin or whether they want to allocate to equity to consider the difference. So I think the place you got to start is if you are a company, you're an economic creature, and everything in the economy, everything in the world wants to kill you. And you need to have that understanding. Whereas Bitcoin is like a monetary virus or an energy virus. A corporation is a creature. And so if you want to understand the risks that corporations face, it's instructive just to start by reading the 10Ks of publicly traded companies. So I would say a very practical education would be to purchase, to get the 10Ks of 10 or 100 different companies and just start to read all the risk factors, because these are actually pretty well written. Corporations spend a huge amount of money on lawyers, and the lawyers are highly educated, extremely thoughtful, extremely articulate, and very risk averse. And they will write pages and pages and pages of risk factors. This is the answer to the investor's question. If I invest $1 in this company, what could go wrong? And they give you an answer. And they really give you a parade of horribles. I've spent many, many years of my life. Since 1998, I've been a public company officer. So I've been studying public company prospectuses and general business risk probably since 2 years before we came public. So that goes back a way. If I were to catalog them into a variety of classifications, I would start here. I would say the first risk of any investor in inequity is governance risk. You're risking your money based upon proper corporate governance exercised by the board of directors and by the management team, so the officers and the directors. If the board is bad or goes bad, or if the directors go bad, they can embezzle funds from the company. They can drive the company off a cliff. They can create a civil war within the company. If they can't work out their issues with each other, or if they can't navigate all of the challenges that approach the company in the future, then the entire thing breaks down. So governance risk is a challenge, and governance risk illustrates the general underlying challenge of corporations in general, which is the people are the weak link. Corporations rely upon human beings, and human action is ultimately the source of most of the liabilities in companies. And what you find is the more human action that is required to run the operation, the more risk there is. And many of the greatest corporations and the most successful equities are the ones that manage to execute on a business strategy with the least amount of human behavior. If the business is so simple that it doesn't need people and there are no decisions to be made and it runs on autopilot, those are generally good businesses. And the more people involved and the more decisions need to be made, the more risky it is. The second risk factor is operational risk. Every business has to do something, whether it's serve food or manufacture ketchup or ship products from point A to point B or fly airplanes or run a factory. The fact that it does something is operational, and if you don't operate the restaurant or the steel refinery or the aircraft properly, then the shareholders suffer. And it takes normally great degrees of talent, sometimes courage, sometimes commitment, in order to operate that business. And in the event of strange volatilities in the environment, the operation gets harder. But operation is never easy. If you've ever been in a steel refinery or an oil drill rig, you would know. Or if you ever try to fly an airplane yourself, even under the best of circumstance, it's not easy to operate. So that's the second risk. The third risk is strategic risk. In my experience, most of the software companies that we competed against, they failed because the board and the CEO made a bad acquisition. So the company will decide, strategically, we need to enter a new business. We're threatened by something. And they will change the operation, and maybe the strategy is, I'm going to acquire another company, so I pay $10 billion for a company that's really only worth $1 billion. And I blow up $9 billion of shareholder capital in one deal. That's just a strategic faux pas. The operation can be fine, but in one decision, the board and the CEO destroy billions and tens of billions of dollars of shareholder capital. And oftentimes, when you make those dilutive acquisitions where you buy something which just blows up in your face, then it's hard to recover from that. 99% of mid-sized software companies go out of business because of dilutive acquisitions. In my career, every single one of my competitors went out of business because it did a string of dilutive acquisitions, which were ill-advised, where they were a weak company and they bought other weak and dying companies in an effort to stave off their own corporate demise. And they just accelerated their own corporate demise while they undermined their product. Even strong companies make these mistakes. Like Microsoft bought portions of Nokia and took multi-billion-dollar write-offs. SAP took a $10 billion write-off. It's always happening in one shape or form or another. That's the third risk. The fourth risk is financial risk. A company has a lot of money moving around. They have to put it in banks. In my career at MicroStrategy, we had money in a Brazilian bank. The bank was embezzled by the CEO. We lost the money. We had money in an Argentine bank. The Argentine government froze all the assets, devalued them. We lost the money. If you actually trust your money to a counterparty and they steal it from you, you're in trouble. So there's credit risk, there's counterparty risk, there's banking risk. You always have it everywhere. And if you trust the wrong financial counterparty, they'll bankrupt you. And we just saw in the crypto industry, we saw lots of companies go out of business in some cases because they trusted another counterparty or they had their assets in another bank.
In the space below, please share your thoughts on Michael Saylor's interview and the recent price fluctuations of Bitcoin. Moreover, make sure to subscribe to the channel, like the video, and view our other crypto-related videos. Thank you for watching.